Assalamualaikum and hi. Today, me and my group members will be presenting about our business finance assignments. I will be explaining about question 1. The first question is calculate ratios for company Sri Meru Sdn Bhd. For the current ratio, we can see that Sri Meru have a higher liquidity, which is 3.8 times compared to industry average of 2.5 times. Then, the inventory turnover for ratio for Sri Meru Sdn Bhd is lower, which is 2.65 times to be compared with industry average of 4.5 times. After that, the average collection period for Sri Meru is 101 days, while industry average is 80 days, which is 21 days in comparison. Moving on to the next ratio, which is non-current asset turnover. We can see that Sri Meru Sdn Bhd is 5.36 times, which is above the industry average of 4.1 times. For total assets turnover, the company has 1.34 times, which is lower than industry average of 1.5 times. Next, the company has higher debt ratio of 29.09% compared with industry average of 22%. For time interest earned, Sri Meru Sdn Bhd able to pay interest 14 times, while industry average is 9.6 times. Sri Meru also have a slightly lower ratio in net profit margin of 9.43%, while industry average is 10%. The Sri Meru Sdn Bhd generate lower return on assets, which is 12.61%, while industry average is 15%. For the last ratio, the company has a lower return on equity ratio of 17.78%, while industry average is 19.23%. Now, moving on to the second question, which is the areas of firm liquidity, leverage, profitability, and asset management ratio. The first area is liquidity ratio. It includes the current ratio of Sri Meru Sdn Bhd. They have a higher current ratio compared with industry average. It means that they are able to meet short-term obligation, which is the ratio is more than 1, and it indicates they have a sufficient of cash. For leverage areas, it includes debt ratio and time interest earned. It shows that Sri Meru have a higher debt, which is not preferable, as they will have potential loss and they able to pay 14 times of interest higher than industry average, which is good for the company. Next, for profitability areas, it includes three ratio, which is net profit margin, return on assets, and return on equity. It shows that they have slightly lower net profit margin caused by slightly high cost of production and other expenses. Then, they have lower return on assets that indicates whether Sri Meru have the ability to make profit or not. After that, they have lower ratio in making return on equity. It shows that the profit earned by the common stockholder from the investment. And the last question for question 1 is weakness and recommendation appropriate to be taken by Sri Meru Sdn Bhd. The first weaknesses that we found is high debt ratio due to the over-reliance in debt financing. To improve this, they need to issue more shares, taking less debt and paying off their existing debt. The second weaknesses is lower net profit margin because they generate a slightly smaller profit. To overcome this, they need to make cost reduction and revenue growth or both of it. The third weaknesses is lower return on assets due to the less generating return. They need to reallocate assets to more profitable ventures or optimizing their assets. So the last one is Sri Meru has lower return on equity due to lower profitability and high financial leverage. As a recommendation, they can issue more shares, pay high dividends, or even increase their profitability.
Now, I will presenting Sri Sdn Bhd trend of revenue, net income, and expenses. For the trend of revenue, between 2020 and 2022, the company experienced continuous growth in revenue. In 2020, the revenue was 5,412 million, increased to 5,734 million in 2021, which is 5.94% growth, and further surged to 6,664 million in 2022, which is 60.22% growth. This consistent annual growth suggests that the company has expanded its operation and strengthened its market position, leading to higher revenue generation. For the calculation is 2021 revenue minus 2020 revenue divided by 2020 revenue times 100. For the 2021 is 5,734 minus 5,412 divided by 5,412 times 100, it will get 5.64%. For the 2022, 6,664 minus 5,734 divided by 5,734 times 100. So it will get 16.22%. For the net income, the company net income has consistent increase over the past 3 years, showing a positive trend. In 2020, the net income was 553 million, which grew by 3.07% to 570 million in 2021, and further increased to 620 million in 2022, reflect a growth of 8.77%. This upward trajectory suggests the company has been successful generating higher profit potential through improved cost management, increased revenue, or combination of both factors. For the calculation, for the 2021, 570 minus 553 divided by 553 times 100, you will get 3.07%. For the 2022, 620 minus 570 divide 570 times 100, you will get 8.77%. For the expenses, Nestle's spending pattern shows some change. The table indicates varying annual costs with expenses totaling 1,157 million in 2020. There was a slight decrease to 1,089 million in 2021, which is a negative 5.86%, followed by a rebound to 1,090 million in 2022, which 0.10 growth. The drop in cost from 2020 to 2021 could signal effort to cut expenses or improve efficiency, possibly through operational streamlining or cost-saving measures. However, the increase in expenses in 2022 suggests that this effort may not have been sustained or that new expenditure will introduced. For the calculation, for the 2021, 1,089 minus 1,157 divide 1,157 times 100, it will get negative 5.87%. For the 2022, 1,090 minus 1,089 divide 1,089 times 100, it will get 0.09%.
So now I will present about the factor that contribute to any significant change in Nestle financial metrics. So let's take a look for the first factor, that is positive revenue and sales growth. Nestle financial metric has experienced a significant change due to the company's success in positively influencing revenue and sales volume. This improvement is attributed to successful product launch, market expansion, and increased consumer demand. These factors collectively contribute to the enhancement of Nestle's overall financial performance. For the second factor is enhanced operational efficiency. Nestle has demonstrated improved operational efficiency, supply chain management, and cost-cutting initiative. This operational enhancement have a direct impact on various financial metrics, including profitability, ratio, and return on asset. By optimizing efficiency in its operation, Nestle is effectively utilizing resources, resulting in improvement financial performance. For the third factor is brand strength and marketing effectiveness. Nestle's powerful brand and successful marketing significantly impact how consumers view and buy its product. They are effectively branding and market contribute to higher market share and revenue. By connecting with consumer through compelling message that resonate with their value, Nestle's strength is market position, leading to continuous growth in sales and revenue. So for the last factor is economic impact and adaptive strategies. Nestle financial performance is affected by change in economy. Economy shift like recession or growth period impact different part of Nestle business, such as customer behavior and investment value. In response to tough economic time, Nestle may take action like stopping new hires, using more cost-effective materials, limiting production and getting extra credit. This action show Nestle ability to adapt and stay strong amid economic uncertainties. That's all from me. Thank you.
I will explain in the first part in the chapter 3, which is the distinction between trend analysis and inter-firm comparison. For the trend analysis, the objective is to serve a financial compass guiding us through the historical trajectory of key final metric. From revenue to profitability, its primary goal is to show the pattern and trend insight into a company performance over time. I have highlighted two benefits and two limitations for the trend analysis. The first benefit is identifying the strengths and weaknesses. Strength analysis helps us identify areas of both strengths and weaknesses within the company performance. These insights become a base for informed decision making, allowing strategic planning and resource allocation to be precise targeted. And the second benefit is the assessment of progress or decline. Trend analysis enable a dynamic assessment of whether the company is progressing or facing declines in key performance areas. This information become instrument in adapting strategy either to capitalize on strength or weaknesses. And the limitation is, the first one is the ignoring external factor. Ignoring external factor means change in industry dynamic or economic conditions might not be capable to consider, means leading to an incomplete or even inaccurate assessment of the company overall health. And the second one is the lack of contextual comparison. The lack of contextual comparison against the industry benchmark or peer firms can pose challenge. Without this context, determining whether observed trend align with this market trend become a complete task. Next, I will move to the second segment, which is the inter-firm comparison. The objective of inter-firm comparison is a strategy designed to assess a company performance relative to its competitor by dive into the financial statement, ratios, and other relevant metrics. I also highlight two benefits and two limitations for the inter-firm comparison. The first benefit is competitive advantage discovery. Competitive advantage discovery means by comparing a company to its competitor, we can identify the area where we are outperformed. And the second one is the contextual assessment of performance. This comparative analysis creates a benchmark offering a positive or negative standards against which the company performed can be measured. For the first limitation for the inter-firm comparison is the difficulty in choosing comparable firm. Ensuring valid and meaningful comparison requires a consideration of variation in size, business model, and geographical location. Failure to do that may lead to wrong in making conclusion. And the second one is neglect of business model difference. This limitation become particularly relevant if the compared firm have fundamental different approach to their markets, which is it can potentially incline the evaluations. Next, I will move to the last question in question 3, which is inherent problem and constraint of ratio analysis. The first one is the issues of limited information arise. Ratio rely on historical financial data, offering a snapshot of the past. For example, change in economic condition, industry trend, or corporate strategy may not be adequate captured by this historical ratio. The second one, which is the difference in accounting policies and method among company can introduce inconsistent in ratio comparison. For example, variation in depreciation method such as the straight line method versus the decline balance method can impact the accuracy and relevance of the financial ratio. And the third one is the practice of window dressing introduce another challenge. Company may manipulate financial statement to create a more favorable impression. For example, this could involve delaying the recognition of expenses or accelerate revenue recognition, leading to temporary improvement in specific ratio.